This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
TradeFlow Capital Management is pleased to be one of the founding members of the Trade Finance Working Group launched on the 27th of January 2023. Created under the auspices of the Alternative Credit Council and AIMA, the Alternative Investment Management Association, the working group brings together alternative lenders in the trade finance sector to support the development of trade finance as an asset class, with the remit to raise awareness of trade finance amongst investors and address challenges to greater participation by alternative lenders in the sector. Joining this group aligns perfectly with TradeFlow's experience in this asset class and its mission to help reduce the growing trade finance gap faced by SMEs.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
U.S. crude production will rise in 2023 even as demand flattens, the U.S. Energy Information Administration, EIA, said on Tuesday in its short-term energy outlook. EIA's latest forecast calls for crude oil production to rise by 590,000 barrels per day, to 12.49 million barrels per day, BPD, in 2023, and by another 160,000 barrels to 12.65 million barrels of oil per day next year. The gains still mark a slowdown in volume growth, which has been constrained by rising costs, dwindling reserves and pressures from investors on producers to hold down their spending.
Western sanctions on Russia have significantly reduced state oil revenues and diverted tens of billions of dollars towards shipping and refining firms, some with Russian connections. Most of the winners from the sanctions are based in China, India, Greece and the United Arab Emirates, at least 20 trading and banking sources said. A handful are partly owned by Russian companies. None of the firms is breaching sanctions, the sources told Reuters, but they have benefited from measures designed by the European Union and the United States to reduce the revenues of what they call Russian President Vladimir Putin's war machine.
Moving on to the top news in the energy sector.
Russian Deputy Prime Minister Alexander Novak said on Wednesday that European Union moves to add what he called exemptions to its price cap on oil products showed that Russian oil was still in demand. Yesterday we saw another change to the European Union's regulations, the exemptions, he said in comments published by the state-run TASS news agency. This once again emphasizes that our oil products are in demand in Europe. Once European politicians indicated that their actions defy any logic and take such decisions and think how to get out of this situation, he said.
Oil prices extended their two-day winning streak on Wednesday, posting slight gains as the dollar weakened, while investors awaited more inventory data for clearer cues on demand trends. Brent crude futures rose 17 cents, or 0.2%, to $83.86 a barrel by 0740 GMT, after gaining 3.3% in the previous session. U.S. West Texas Intermediate crude futures climbed 31 cents, or 0.4%, to $77.45, after adding 4.1% in the previous session. Oil benchmarks are expected to retain support after Federal Reserve Chair Jerome Powell sounded less hawkish on interest rates than markets had expected, while the latest data showed U.S. crude inventories fell despite earlier expectations of a climb. Next, we have the top news in metal markets. Gold prices rose on Wednesday as the dollar pulled back from a one-month peak after comments by U.S. Federal Reserve Chair Jerome Powell were seen as less hawkish than expected. Spot gold was up 0.4% at $1,880.97 per ounce, as of 0744 GMT. U.S. gold futures also rose 0.4% at $1,880.10. The U.S. Fed may continue to raise rates or maintain present rates to tackle inflation but probably in a less aggressive way, said Harish V., head of commodity research at Geojit Financial Services.
A U.S. federal appeals court upheld the imposition of higher tariffs on some imported steel products, reversing a lower court ruling that the Trump administration waited too long to act. Tuesday's 3-0 decision by the U.S. Federal Circuit Court of Appeals in Washington, D.C. covers imports of steel derivatives, such as nails and fasteners, that were subjected to 25% tariffs in a January 2020 proclamation by then-President Donald Trump. Similar tariffs on other imported steel items including flat-rolled products, tubes and pipes had been imposed in 2018, after then Commerce Secretary Wilbur Ross found that imports threatened national security by eroding demand for U.S. steel and depressing the use of domestic steel producing capacity.
We will now look at the top news in the agricultural.
Russia said on Wednesday that work to unblock Russian exports under the Black Sea grain deal was unsatisfactory, accusing the European Union of failing to deliver on its promises, the TASS news agency reported. The comments, made by Russian Deputy Foreign Minister Alexander Grushko, refer to the United Nations brokered agreement between Moscow and Kyiv that aimed to free up grain exports held up at Black Sea ports by the war in Ukraine. President Vladimir Putin said last year that Russia and the developing world had been cheated by the Ukrainian grain export deal, vowing to revise its terms to limit the countries that can receive shipments. That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.